Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon free webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars and shows, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer. And let's welcome Dimitri Pargamonic to the stage, who's going to talk Implied Volatility Skew. Explain. How you doing, Dima?
Good morning, Will. How are you?
Great. Let me share your screen.
Yeah.
And there we're on the Market Chameleon landing page.
Yep. So I think to demonstrate this, I'm going to go to a stock symbol. Then we'll discuss implied volatility skew, and then also look at a way where can we use some benchmarks to give us quick insights into the skew. So let's take, for example, I'm going to go to Google. We'll type in Google in the search box. This will take us to Google's main summary page. And first, just so you know what skew is, I'm going to go to the options chain actually and just show you what I mean by skew. Let me go. This is Google's options chain. I'm going to just pick a expiration here. Let's do January 16th. And when we look at option prices, let me close this menu to expand the screen. When we look at option prices, we need to kind of get a sense of how to give it a value so we know like the relative price, relative value of these options, because we have all these different prices, but these options are different, right? Like you have different strikes. So since you have different strikes, their characteristics are different. They expired in the same expiration, but of course, a option that is 7% out of the money is going to be a different price than something that is like right at the money. But on a relative basis, which one has more premium baked into it? Because everybody would agree that should be less, but what's a better deal relatively? And that's where we use the Black-Scholes model to give us this relative value and implied volatility. Okay, and think of if I had to just kind of make an analogy, a relative value would be if I'm comparing two rental properties, right? One is 100,000, one is 200,000, one is 300,000. So there are different prices, but they might not all be the same. The desirability of one could be more than the other, or on a relative basis, one earns more return than the other. So think of it like this. If I just said 100,000, 300,000, if everything's the same, 100,000 seems like a better deal. But if I told you, well, the one that's 100,000, the rent is 10,000 a year, right? So let's say 10% cap. But let's say the one that's 300,000, the rent is 60,000 a year. So you got a 20%. So on a relative basis, for every dollar invested, you're making more. And that's kind of like the Black-Scholes model where we're putting, if I had to put a CapEx on, this is a 10%, return on investable dollars. This is a 20% return. And the implied volatility kind of has that similar, theory or idea, but it's not returns. It's in the implied volatility of the stock. And this way we could start comparing these options on that relative basis. But you could see that the implied vols are different, right, for each option. They don't have to be the same. We have bids, we have offers, we have different strikes. And what the skew is telling us is that on a relative basis, there might be more demand to own certain options or certain premium, and then there might be on the other side to sell certain premium. So if there's demand maybe for options with higher strikes, you could see implied volatility start to get skewed higher than, for example, options with strikes closer to the at the money, right? So if, Google 326, here are the strikes around 326. You see the implied vols, but they start going up, right? And maybe even on the way down, they start going up. And this creates this skew where it lets us know, well, the implied vols are skewed higher, on these strikes and skewed lower on these strikes, implying that there's more demand for certain strikes. And looking at this, how do we, because we have so many different strikes here, and we have these different expirations, and these different expirations could have different skews. Some could, this skews a little bit flatter, it looks like, but it's still kind of also skewed higher as we go up higher in strikes, and skewed higher as we go lower in strikes. So this looks more like a smile. It's not always the case. Sometimes, the skew could be declining on the way up. It could be flat across. It could be, higher demand for at the monies versus the wings. It could move around, even intraday. So what's helpful is, can we benchmark this to get kind of a quick idea of like what the skew looks like? Is it going up? Is it going down? So that's what we're going to look at is, can we just use quick benchmarks so we could kind of get an idea without having to look, through every strike, through every expiration. And then if we see something interesting, then we could go and look at this expiration. So I'm going to go up here to the menu, and what we'll do is look at this single leg dashboard. I think there are a few different ways to do it, but I'll just do it from this single leg dashboard. And click on this, and I'm going to close this menu here. And I'm just going to slide down for a little bit here. Let's slide down to this table. So you see this table, it lists the different expirations for Google. We could tab through, to all of them or expand it. But let's just go look at the first set of 10. And we need to kind of put it in relative terms, because how do we know skew, right? Well, skew means that something is higher or lower relative to something, right? So we need like this something to compare it to. Is, like the example I gave you. Well, if we took a benchmark and said, okay, well, if the average of, all these rental properties is a 12% cap, well, is this one higher or lower, right? So we need like these relative comparisons. So what we'll do is say, well, if it's a skew, we'll use the at the monies as our initial benchmark and say, well, what are the implied volatilities right around at the monies? And that's kind of typical to reference the at the monies, because those are the options that are right around the strikes, were the closest to the stock price. So that's where the consensus is, well, how much volatility we're going to see right from the strike, right? And usually that's where you get most of the trading as well. So those are kind of the most liquid options. So if we took the at the money as our benchmark, right, for each expiration, well, then we need to compare, well, are the options higher, moving, skewed implied volatilities, are they moving up or down, and the options lower? And to normalize that, what we do is say, well, if we ran a straight skew, right? So if, let's say I have 26.1, this is the expiration we're looking at. Well, we took 26.1 and just applied it across the board, right? We took each option, said 26.1. Well, if there's no skew, then each option will be 26.1. But then what we do is we'll find the 25 delta call and put, so that we have to reference something if we need some kind of a benchmark. Let's reference the 25 delta because that's an out of the money option, but it's still meaningful. It has 25 delta. 25 delta put, that's an out of the money option, but it's still meaningful. It has 25 delta put. And what we could do is just say, okay, well, if I ran a straight skew based on this 26.1, the option would be X, but if I find it, well, the implied volatility is different. That means there's a skew. It's different than 26.1. Well, how much is it different by? Is it higher or it's lower? That's what this is doing. This is saying, well, it's higher by 1.2%. And the 25 delta put. So then we could go look at the options below and we find it. That one is higher by 3.5%. So what this is saying is the wings are skewed higher. That's what it's implying here, right? But it's not like this. You could see as we go out further in time, with February 6th, we have a higher at the money IV, but then we have the 25 delta still skewed higher, but the 25 delta calls are skewed lower, meaning that the higher strikes now are skewed a little bit below that, the monies, while the lower strikes are skewed higher. And this gives us this relative value, which we could see how these options line up, using these benchmarks. And this could be a quick way, instead of going through the options chain, of looking through it. And it's one way we could, now that we've kind of normalized it, we could look at similar options. Well, is Meta the same? Is Apple options the same? And so forth. One more thing before I end it there. Well, this is the skew. But like anything, maybe we want to know, well, how much did it change by? It's kind of like saying, here's the relative stock price, right? I could say, look, a relative stock price could be something like a PE, it's PE is 20. Okay. But how much did it change by, right? That's another question, like from yesterday to today. So now, of course, the earnings don't update every day. So, but if they did, if we had new earnings and new price, we could always just see how that PE is holding up. So here, we need to kind of measure that skew. So what we would do is say, well, how much did it change by? How much did this, if we compared the same strikes, from day to day, and normalized it, well, we see that the at the money's increased by 1.6%. So this did increase, okay, from previous day's close. And this is looking strike to strike, not delta to delta. And what we see is that strike to strike, the skew actually increased on both. So the relative, even though it's lower, right, even though we're still lower skew wise, but it ticked up. It's not as low as it used to be, is what it's saying. That this ticked up a little bit. So, if the skew, if it was more dominant yesterday than today on the upside, and it increased a little bit on the downside. So, well, I'm going to stop it there. I think we gave it a good overall today.
Great job, D, as always. Thanks for bringing these to the Chameleon community. It's Friday, so we won't see you till Monday. You have a great trading day and a good weekend, D.
All right. Thanks, everyone. Stay safe out there. Have a great trading day. We hope to see you Monday.
Great in peace, D. Have a great day. We'll see you later. Bye. Hey, everyone. Thanks again for joining the Market Chameleon webinar series. Remember to check out the weekend webinar series of the webinars that are pre-recorded. They'll be going out. You'll see the emails, and you can chat if you want on the weekends. Thanks for all the advice on my upcoming trip to Palm Springs with one of my children and my wife. We're looking forward to it. Some great recommendations. Everyone have a great weekend, a safe trading day. If you're new to the platform, please follow us on YouTube. So there are some great webinars, historical webinars there. Some of them are so old, you'll see the older Chameleon features that don't even exist anymore. So lots of interesting stuff there for you to educate yourself on. Everyone have a great trading day today and a safe weekend, and we will see you on Monday.